So, every single investor, whether you're just starting out or you've been at this for years, is staring down the same big question. How in the world do you find a good stock? It sounds so simple, right? But the answer actually splits the investing world into two very different and often competing philosophies. Today, we're going to get into both of them, value investing versus growth investing.
All right, so here's our game plan. First, we have to tackle the single most important idea in all of investing. Then, we're going to put on our detective hats and see how value investors operate. After that, we'll switch gears and think like futurists with the growth investing crowd. Then, we'll open up the toolbox and look at the numbers that really matter. And finally, we'll figure out how you can start to think about your own personal investing style.
Okay, let's dive right into this first absolutely critical concept. And look, if you get this one thing, everything else we talk about today is going to click into place. This is really the difference between just gambling on the market and actually investing in it. Let me just throw this at you. A stock's price is $300 a share. So, is that a good deal? Is it expensive? A total bargain? The honest truth is, there's no way to know. Because that price tag all by itself tells you absolutely nothing. Zero. And this is where the legendary Warren Buffett just nails it with this simple quote. It's really the bedrock of all smart investing. Price, that's just the number on the screen. It's the market's mood today. But value, now that's the real stuff. That's what the business you're buying a piece of is actually fundamentally worth.
So think of it like this. Price is all about the hype. It's a popularity contest driven by supply and demand. If a ton of people suddenly want a stock, the price goes up. Simple. Value, on the other hand, is about what's under the hood. It's about the company's real financial health, how much money it actually makes, the stuff it owns. Getting that difference is what separates smart strategy from just blind luck.
All right, let's put on our detective hats and dig into our first school of thought, value investing. I want you to picture a value investor like a master bargain hunter, sifting through the clearance rack of the stock market, looking for absolute treasures that everybody else has just walked right past.
And the number one tool for this detective? It's called fundamental analysis. Now, this isn't about chasing hot tips you saw on the internet or having a gut feeling. No. This is about rolling up your sleeves, cracking open a company's financial reports, and doing the hard work to figure out, is this business actually strong and healthy? You're trying to calculate its true intrinsic worth. And hey, who better to learn from than the master himself, Warren Buffett? He's got a pretty clear checklist. First, are there smart, trustworthy people running the show? Second, he absolutely hates debt. A debt-to-equity ratio under 0.5 is a great sign. It means the company isn't relying on borrowed money to survive. Third, can they pay their bills? A current ratio over 1.5 means, yeah, they've got plenty of cash on hand. And only after a company passes all those tests does he ask the million-dollar question, is it on sale? Okay, now this might look like a math quiz, but stick with me because it's a really neat little shortcut from Buffett's own mentor, Benjamin Graham. It's a quick screen. You take two numbers, the price to earnings, or PE, and the price to book, or PBV, which is basically how the price compares to the company's net assets. You multiply them together. If that final number is less than 22.5, Graham's rule says you might, just might, have found a solid, undervalued company. All right, let's just do a complete 180 here and look at a totally different way of thinking. If value investors are detectives studying the past and present, then growth investors are futurists. They're trying to imagine what the world and a specific company is going to look like 5, 10, even 20 years from now. And this is where your brain has to shift gears, because a growth investor isn't necessarily looking for a bargain today. Not at all. They're often willing to pay what looks like a high price for a company they believe is on its way to completely dominating an industry. They are buying the story, the trajectory, the potential, not just the members on today's spreadsheet. This chart just perfectly lays out the choice. Look at ABC Corp on the left. Yeah, it's making money today. That's a positive bar. But see that downward arrow? Its profits are shrinking. That could be a blockbuster video. Now look at XYZ Corp. Sure, it's losing money right now. The bar is in the negative. But look at that trend line. It's rocketing upwards. That could be an early-stage Netflix. A growth investor ignores today's losses and bets on that upward arrow. And a lot of times, this comes down to size. You've got your large cap companies, your P&Gs of the world. They're like giant, stable cruise ships. They're not going to sink, but they're not going to break any speed records either. Then you have the small caps. That's Steve Jobs in his garage. It is incredibly risky, a total moonshot, but if it works, the growth potential is just off the charts. So when these growth companies do make a profit, what do they do with it?
Do you get a nice little check in the mail? Nope. They pour every single dollar right back into the business. They use it to fund research, to expand my crazy, and to just gobble up market share. The goal isn't to pay you today, it's to make your investment worth way, way more down the line. So we've got these two very different approaches, but how do we actually measure this stuff? How do we put numbers to these ideas? Well, let's open up the Investigator's Toolkit and look at the key metrics that investors use for both value and growth.
The granddaddy of all metrics is probably the PE ratio. It's just a super straightforward way to see how expensive a stock might be. It connects the P for price right to the E for earnings. So a PE of 14 literally means you are paying $14 for every $1 of profit the company makes. Generally, a lower PE is seen as being cheaper.
But here's the thing about the PE ratio. It has a massive blind spot. It tells you nothing about growth. And that's where the PEG ratio comes in. And honestly, it's like a secret weapon. It takes that PE ratio and puts it into context by dividing it by the company's growth rate. It's this beautiful little metric that connects the world of value with the world of growth. A PEG under 1 is often a sign that you're getting a whole lot of growth for a pretty reasonable price.
Let's see this thing in action with a real-world showdown. Not too long ago, Procter & Gamble and Apple had almost identical PE ratios, both hovering around 14. Now, if you only looked at that, you might think, they're basically the same price. But then you look at the PEG ratio. P&G was at 1.55. Apple, a tiny 0.61. So what does this all mean? It means that even though you were paying about the same sticker price for $1 of their current earnings, Apple's earnings were growing way, way faster. That super low PEG ratio was a giant flashing light that with Apple, you were buying into a much more dynamic growth story. From a growth perspective, it was the much better deal. Okay, we've seen the philosophies, we've seen the mindsets, we've looked at the tools. So now for the big one. How do you actually choose? Which path is the right one for you? Well, the answer really boils down to one simple question. What do you want your money to do for you? Are you trying to grow your pile of money over the long haul, hoping the price goes up so you can sell for a profit later? That's a capital gains goal, and it lines up perfectly with growth investing. Or are you looking for your investments to create a steady stream of income for you right now? That's a cash flow goal, and that's often the focus for value investors who love those stable, dividend-paying companies. So let's just boil it down one more time. The value investor is a pragmatist. They ask, what is this thing worth today? And they're hunting for a discount. The growth investor is a visionary. They ask, what could this be worth tomorrow? And they're betting on that potential. And remember, both are doing their homework. Both are using fundamental analysis. They're just prioritizing different clues. And at the end of the day, which strategy is best really depends on your own goals, your timeline, and frankly, how much risk you're comfortable taking. And you know what? You don't actually have to pick a team here. This isn't a sports rivalry. In fact, many of the smartest investors out there build portfolios that have a healthy mix of both. They balance that reliable, steady income from value stocks with the massive upside potential of growth stocks. And that really brings us to our final thought for you to chew on. As you go on your own investing journey, who are you, really? Are you that bargain hunter, thrilled by finding a hidden gem? Are you the futurist, excited by the possibility of what's next? Or do you see the wisdom in being a little bit of both? The choice is all yours.